that we can see how much we can cover for the evening. So let's look very fast. Let's move very fast if possible. The last class we looked at profitability ratios. So today let's look at liquidity very quickly, even though we have a lot of liquidity ratios, some activity ratios. I moved them to liquidity, but then let's be fast. They are not new ratios, just maybe one or two that are new that will take our time. So as usual, I just do 2020 for the same damn Kabir. Then you do 2021 and 2022. So let's rush. Let's see if we can finish liquidity in 1 hour before our break by 9, and see if we can move to activity and efficiency, if possible, depending on our speed and deliberations. Mostly it's the interpretation that normally keeps us, because we need to understand how to interpret the ratios, which takes a chunk of our marks during the exams. Okay, so by way of introduction, liquidity ratios evaluate a company's ability to meet short-term obligations. So short-term, talking about day-to-day transactions, 24 hours, 7 days a week, 4 months, or 4 weeks for a month. So maximum a month. We're looking at liquidity for day-to-day operations, 7 days a week, and 4 weeks in a month. So you want to meet these obligations using your most liquid assets. So not your long-term assets, which are in form of non-current assets, but your most liquid, which are short-term assets. These ratios provide insights into a company's capacity to quickly convert assets into cash to pay up current liabilities. So when we have current assets, we need to use them to pay up current liabilities, which are also day-to-day, week-to-week, month-to-month obligations, ensuring smooth business operations without running into cash flow problems. This is very important to note. Liquidity ratios are essential for assessing a business short-term financial health. So you're looking at your day-to-day health, month-to-month, day-to-day, week-to-week, and month-to-month operational efficiency, and the ability to avoid financial distress. I mean, it's embarrassing to say that you don't even have petty cash to meet little needs like short-term exigencies in the office that came up. It can be embarrassing not to have cash on ground to meet those little day-to-day needs. So to avoid such embarrassment and stress, liquidity ratios help us address efficiently this essential short-term financial health of the company. A company with strong liquid ratios is generally considered to have a better ability to manage its day-to-day operations. Exactly. So like I said, day-to-day, week-to-week, month-to-month, once there is liquidity or liquid assets, the company is able to maintain credibility with creditors and withstand unforeseen challenges in the short term. These ratios are valuable to investors, creditors, and management, as they provide an understanding of whether the company can sustain operations in the short or near term and ensure timely debt repayment, that is short-term debts, current liabilities in the form of trade creditors, accruals, and other immediate needs that arise. Okay, so having introduced that, let's quickly go into the first and most important ratio that speaks to liquidity, which is the current ratio. It's one of the main ratios that establishes the relationship between an entity's current assets and current liabilities. So its purpose is to measure the entity's or the company's ability to meet its short-term financial obligations out of current assets. Current assets talking about the short form of assets, the investment in short-term assets and not the long-term assets. It's calculated as your current assets divided by current liabilities, a very popular ratio. It means the company measures the ability to pay short-term obligations with short-term assets. Another formula, or the formula, looks at current assets by dividing it against current liabilities, like we saw here. So a higher ratio indicates better liquidity, meaning the company is more capable of covering its debt. Okay, so let's display our understanding of this short introduction by way of using the formula to speak to the ratio. So let me just share my screen quickly as we look at, as we'll be toggling the screen to be able to address these ratios very practically. Okay, so back to Dam Kabir. Now, Dam Kabir is on the screen. We'll be dealing mainly on our SFP, where we'll be calculating the ratios. So, practically, we are having our current assets, and don't forget beginning and the end of the year. So take note of that. So we have inventory, we have trade receivables, we have cash and cash equivalents, marketable securities, treasury bills, certificate of deposit, money market funds, commercial papers, foreign currency deposit as our current assets. So what's the total of the current asset? We have it as at the end of the year, don't forget, we're picking 1,097,250. So let me take that to my Excel, as I usually do, and we take for the first year. So it's very simple to calculate, and we should be able to run. I don't think we'll have any challenges here, except we come to the unpopular ratio. So we have the total current asset as it is on the screen. So you have your current ratio, your current asset divided by your current liability. So let's go pick our current liabilities from Dam Kabir. And that will be under our current liability section. And we have trade payables, accrual expenses, short-term borrowings, and we have total dividends for ordinary shareholders, and we have preference dividends for preference shareholders. So our total current liability is about 420 million at the close of the year. So we'll pick that and we'll add to our sheet that we're using to calculate. Okay, so now our current ratio, very simply, is our current assets divided by our current liabilities. So we have it as exactly 2.61 times 1 of the current liability. So what does it mean? It means we have 2 times 2.61 much of current assets above our current liabilities, and current liabilities is 1. So 2.61 is to ratio 1 is our current ratio, which is sufficient. That means our current asset covers our current liabilities about 2.61 times. Fantastic. So in 2020, their liquidity makes a lot of sense. Okay, so ladies and gentlemen, let's go now to the current assets for 2021. So please, the floor is yours. I've done mine. Let's go. Let's go ACAs. So you have your current assets and your current liabilities. So what's your figure? I have to be fast now. We didn't start early. We started like 10 minutes after 8. So run. What's the current ratio for 2021 and 2022? I see Aisha is on the call. ACA Zakaria is on the call. You guys are welcome. I was speaking when you guys joined. So nice to have you on the call.
Thank you, sir. Good evening, sir.
You're welcome. You're welcome. Good to have you. I think Zakaria is having network issues. He's off again. So Rufi, Julie, what do we have? Aisha, I hope you are computing.
2021 is 2.64. 21
Okay.
is 2.64.
2.64.
Can you hear me? I've been asked.
Oh, okay. I'm just hearing you now. I'm just hearing you and you're breaking, but I had 2.64 is to 1. Is that what you have? This network is okay. All right, Rufi, what do you have? I had Julie say 2.64 before her network went off. All right, so Rufi, what do you have? Aisha, what do you have? This must be network. This must be network, I guess. But I've ceased hearing any of you. Sure, the network is so bad. Please, if you are speaking, let me know so that it's network now. Okay, Aisha and Rufi is on. You guys are on the call. Can you hear me? It's like Julie went off to come back. I'm sure the network is bad.
I can hear you, sir. Sorry, I'm trying to settle in. I'm just coming back.
No problem. Okay, no problem. What of Rufi? Rufi, are you there?
Hello, sir. Yes, I'm calculating.
Oh, okay. Fantastic. All right, fantastic. I think Julie went off to
Yes,
come back so that.
I have the figure now.
Okay, what do you have?
For 2021, 2.64.
Okay, 2.64 is to 1. Yeah, very good. So what do
Then
you have in
for
20?
2022, 4.02. I'll just say 4.02.
4.02. Okay, so that's is to 1, right?
Yes.
Okay, fantastic. All right, can we have Aisha now, or we should let you settle down for now?
Exactly. I'll just pass, please. So is it done, Kabir?
Okay. Yes, it's done, Kabir. So we are working on our liquidity ratio.
No.
Yes, it's the same
I'll
Dan
pass
Kabir.
off. I'll
Okay,
pass off.
that's fine. All right. So let's validate what Rufi has calculated as her ratios. So let's go. So we have 2.61 to 1 as 2020. So let me go pick 2021 and 2022. So I have total current assets as 1.2 and 1.4 for 2021 and 2022 respectively. Okay. So let me just post the figures here and take them one by one. Okay. So I have it exactly here for 2020 and 2021. 21. So let me go pick the current liability. The total current liability for 2021 and 2022, 461 and 530. Okay, and that's it. So let me just drag this. Okay, so I think I'm having a differing figure from Rufi. Rufi, so what did you do? We are correct in 2020, but we are not in 2021. So who is wrong? Am I the one or you are the one? Rufi, will you check your figures?
Yes, I mixed up the figures. I picked total assets.
You pick total assets, okay.
In the
No
second
wonder
year,
you have.
yes, I mixed up the figure. Yes.
Yes, I noticed you have
So you're
4.02.
correct. I've confirmed.
Okay, I'm correct, right? Rufi is
Yes.
incorrect. Okay,
Yes.
fantastic. All right, that's nice. That's good. She has found out where she has an issue and she picked total assets. Okay, so more importantly, what does it mean? Now, the meaning is we are measuring a company's ability to pay its short-term liabilities within its short-term assets. And we are looking at the formula by dividing current assets by current liabilities. And where you have a higher ratio, in this case, Bank Kabir is doing well because the liabilities are covered up by the asset more than once. So it shows sufficiency of current assets to cover liabilities for running the business in the short run, meaning the company is more capable of covering its short-term debts. And the implication is that the current ratio implies that the company has more than enough assets to cover its short-term liabilities, reflecting strong liquidity. So more than 1, 2, and in Dan Kabir's case, we have 2.6. So if you approximate it, it's about 3 times, which is sufficient. But when you have a lower ratio, maybe lower than once, it indicates potential difficulty in meeting short-term obligations, suggesting weaker financial health. What causes a high or low current ratio? Excess inventory or receivables. The company may hold too much stock, which is inventory, and have a high amount of unpaid receivables, talking about credit sales or high debt outside. You issue out credit and you've not recouped back the money after the agreed period. And that's what receivables, unpaid receivables, are all about. Another cause of a high one is conservative financial management. The company may maintain a large cash reserve to ensure liquidity. And the causes also is low debt level, where a company has fewer liabilities compared to assets. Looking at Dan Kabir's case, for example, it culminates in a high current ratio. While a low current ratio indicates insufficient cash flow, a lower one is looking at 1:1 and lesser. So where your current asset is 1 and is less, there is a struggle to pay meet current liabilities. The company may struggle with cash flow, limiting its ability to meet obligations. Another cause of a low current ratio is high short-term obligations or liabilities. The company may have too many short-term debts, and operational issues is another cause. Inefficient management of working capital, such as delays in recouping receivables or excess inventory that has been tied down in the store. So this could be the challenge. Now, what are the effects of a high or a low one? So the effects of a high current ratio is strong liquidity position and the ability to easily meet obligations. So that's the effect. While negatively, it could indicate inefficient use of resources with assets tied up in inventory or receivables that are not generating profits. So the high current ratio, the positive reason is you have strong liquidity position to meet your obligations. while a -1 or a lower current ratio is you are inefficiently using your current assets or current ratio to in form of assets tied up in inventory and receivables, and they are not generating profits or helping you to meet your day-to-day obligations. While a low current ratio suggests efficient use of working capital, or may suggest efficient use of working capital if the company is meeting obligations without holding excess assets. So a low current ratio may be positive, and working capital is enhanced with a low ratio, maybe as low as 1:1, while negatively you risk liquidity issues and possible financial distress or difficulty in paying short-term debts are the challenges or the risk associated with having a low current ratio. So when you have lesser than 1 current asset to 1 current liabilities, is very risky, very, very risky. So in conclusion, the current ratio is a key liquidity measure that shows a company's ability to meet its short-term obligations with its short-term assets. So balance is the key. Balance to ensure that you don't go below the threshold of 1, and it depends on the industry and how your day-to-day activities are. So chartered accountants are supposed to monitor this ratio to ensure you don't go below 1, and where your activities are concurrent and recurrent, ensure that 1.52, just ensure you have a sufficient current ratio that meets your financial needs on the short run, on a short-term basis. Looking at balance depends on your industry, and it indicates financial or good financial health. But extremes, when you have too high or too low, can signal inefficiencies or potential liquidity issues. So when you say too high, if you have as high as 3 or 4, you may be tying down some of your assets in the name of meeting liquidity needs. But if you have it too low also, is a risk where you may run out of money, unforeseen challenges or circumstances. So balance is key in managing liquidity or your current issues. It's essential for assessing a company's day-to-day financial stability, and chartered accountants should monitor this ratio to ensure that balance is struck and we don't have challenges with our day-to-day running. Okay, so that will be the end of current ratio. Julie, you're welcome back. Sorry you had network glitches. I hope your network is a bit stable now.
Yes, it was really bad, so I had to change the network to MTN.
Yes,
but I already
noticed that.
calculated it before I left, and I was trying to save my figures, but I guess you were not hearing me, so I tried to go out, and to come back again was difficult, but it's okay.
Yeah, fantastic. So let's go back to your figures, because I had that of Rufi only. Aisha was settling in. So can we have your figure for 2022?
2.64. 2022 was 2.65. 2021 was 2.64.
Exactly. So yes, so you are correct. Exactly. As you can see on my screen, that's the same thing I have. 2.64, 2.65. So we're on the same page. Rufi mistakenly took, I think non-current asset or total asset or something. So she had a high figure here, 4.02, but she has rectified that correctly. So we're on the same page, myself and Julie, and all of us are correct now on the current ratio. It's quite a simple ratio, and the interpretation as well. So do we have any questions? I haven't spoken to the numbers. Any questions on current ratio? Do you have any challenge? You need any clarification, so that we can run to the next one, which is quick asset ratio or asset test ratio. Okay, I believe our silence means we understand that it's a simple ratio actually. So let's run. The quick asset ratio, also known as asset test, is a financial metric that measures a company's ability to meet short-term liabilities without relying on the sale of inventory. That's why it's called asset test. It provides a more stringent assessment of liquidity compared to current ratio, because you are excluding inventory from the current assets. Since an entity's inventory may not in most cases be quickly turned to cash, I give you a scenario, maybe the company sells shoes, and the turnaround time for shoes to go to the market and be sold off, especially if you don't have a distribution chain that sells to distributors, may take longer time. So in such cases, you may need to exclude inventory from your current assets because the money may not come back quickly. So eliminating the inventory from your current asset in calculating quick ratio, you want to see the current asset items that quickly is converted to cash so that you can run your day-to-day expenses. At most, maybe 30 days, inventory goes out and the money comes back, or any receivables or cash that you have in 30 days comes back. And where it doesn't meet that 30 days threshold, you quickly exclude the inventory from quick assets. That's a brief scenario we could paint to explain why you are removing inventory from your calculation of this ratio. Now, it's a more stringent test, and that's why it's called acid test of the company's ability to meet its short-term financial commitments. So the calculation is simple. You remove inventory from current assets and you divide it by current liabilities. So it quantifies a company's short-term financial health by indicating how well it can cover its current liabilities with its most liquid assets. So you exclude inventory, you have your receivables, you have your cash and other liquid assets, and a ratio of 1 or above suggests the company has enough liquid asset to pay its current obligations. Very important. So where you have 1 and above, especially for quick asset ratio or acid test ratio, the company is sufficient enough to meet its day-to-day obligations. So let's quickly do that with Kabir, and let's see, excluding inventory, if they meet that benchmark of above 1, which is the general benchmark anyway. Now let me remove inventory from 2020. So from the current liability, the current assets, inventory is 378. So let me pull out 378 from the total inventory of total current asset of 1,097,250. So simply I'll just pick this figure since I already have my current asset here. So let me put this as inventory, and I'll just copy from this sheet and take my current asset. I think this is easier to navigate. I'm going to calculate it or pick it from the figure. So let me say inventory, and I'll have, let me call it my net total current assets. So this minus inventory, I have 71250. So I'll just go pick our current liabilities here so that to be faster, waste of time. And I have 420 as the total current liability. Okay, so what is our acid test ratio or quick asset ratio? So I have it as the net divided by 420. Wow, intriguing. Company is still doing well, even almost 2 times if you approximate it. So it's 1.71 is to 100. 1.00. Fantastic. Okay, ACAs, let's go. What's 2021 and 2022? Quickly. So let me give you the inventory.
1.74 and 1.75.
That was fast. I like that. That was fast. So let me put it down here. 1.74 to 1. Then for 2020, 1.75 is to 1. Okay. As Aisha settled down, Rufi, we are waiting for you. Do you have a differing opinion or a differing figure based on what Julie calculated? Let's hear you. 1.74, 1.75. So from 1.71, the company keeps doing well. 1.74, 1.75. Yeah, shows in the short run, the company is running and doing well at the same time. Fantastic.
$1.74, $1.75.
Fantastic. Very good. Very good. Very good. Very good. Very good. Okay, so we're waiting for Aisha. Aisha, are you ready for us? Aisha, are you ready for us? Let's see if Aisha's still on the call. I think she's trying to settle in. She just came in. Oh, okay. She's off. All right. I think so. I can see Salmat. Salmat, you're welcome to the call. It's nice to have you. We are on.
Good evening, sir. Okay,
Good evening. You're welcome.
Also,
Sorry, what did you say?
I said this network is not taking it easy on us.
Exactly. The network is bad. We are striving. In fact, it's been a bit, it's been challenging today.
Yeah.
At least we are trying. Nice to have you around. Okay. So you're welcome. So we're calculating quick asset ratio. We've just finished liquidity, but the good thing is we are recording. So made the recording available clear after the class. Yeah. So Rufi and Julie, all right, you're welcome. So Rufi and Julie agreed with 1.7 and 1.74 and 1.75. Are we both in agreement with that? Hello, Julie and Rufi. Are we okay with these figures?
Yes.
Okay, yes, fantastic. Sir. Okay, that's nice to hear. So let me validate that. I'll just go and remove inventory. And I want to agree with both of you. Okay, so I'll just come here and pick my current. Fantastic. So I'll have the net. So I'll come again and pick the total liabilities, which is this. And so let me see if it marries exactly 174, 175. So I agree with two people, and we have 174 and 175. So the quick asset ratio shows that Kabir's passed the acid test. Let's put it that way. He passed the acid test, which is above 1. Because from our interpretation here, the general benchmark says a ratio of 1 or above suggests the company has enough liquid assets to pay its current obligations. So more importantly, what does it mean? It means a higher quick ratio implies stronger liquidity, indicating that the company can easily meet its short-term obligations, while a lower one suggests potential liquidity issues, especially where there is no inventory, signaling the company could struggle to pay its short-term debts. And what are the causes of a high quick ratio or quick asset ratio? Efficient cash management, low inventory levels, or significant liquid asset holdings. So low inventory levels indicating that inventory does not have a chunk of the current asset component. And effective cash management shows that the cash component is efficient, especially in the area of petty cash, and other liquid assets can sustain the current asset component. And the effect is that it enhances creditor confidence. So where you have trade creditors that need their money mostly in 30 days, it enhances their confidence that we're able to meet our liquidity obligations or our short-term obligations. It reduces risk of financial distress and potentially better borrowing terms. So maybe where you need overdrafts from the bank for 30 days, 60 days, it's easily granted because you have good current asset or working capital management. Why a low one shows excessive tying down of inventory, poor cash flow, there's no physical cash coming in, and increase in short-term liabilities. These are the causes of a low quick asset ratio, maybe less than 1:1. The effects include increased risk of liquidity problems, creditors asking for their money and you cannot meet it, which could be a challenge, potential inability to meet obligations, and negative impact on credit ratings. So in conclusion, the quick asset ratio is a crucial indicator of a company's liquidity and financial health, offering a clear picture of its ability to meet short-term obligations with liquid assets. So the financial health is very important, especially where you exclude inventory and it's not realistic to include it in that industry or line of business. So as chartered accountants, we need to monitor this ratio to help the stakeholders management access the efficiency of the company's asset management, especially the current asset and its capacity to respond to financial challenges without relying on inventory sales. So excluding inventory sales is very important in assessing this ratio. All right, I think I duplicated the quick asset ratio here. Okay, that's fast. So do we have any question on the quick asset ratio? Is very simple in my view. Any questions on this? All right, I don't think we do. That's fine. Well understood. Okay, so let's move to the third one quickly. One of the simplest also, which is cash ratio. Is a conservative liquidity metric that measures a company's ability to cover its short-term liabilities with its most liquid assets, specifically cash and cash equivalents. So where you have cash, receivables and inventory are not the most liquid assets of an entity. Cash and cash equivalent are the most liquid assets because they are in form of physical cash. This ratio provides a strict assessment of liquidity, indicating how well a company can handle its immediate, so in terms of petty cash, main cash, expenses, without relying on other assets like I've mentioned, receivables and inventory. And the ratio, the calculation is on the screen, cash and cash equivalent. Cash and cash equivalent, looking at the equivalents that can be turned immediately to cash, divided by current liabilities. It means that the ratio quantifies the extent to which a company's cash and cash equivalent can cover its current liabilities. A higher cash ratio indicates strong liquidity position, showing that the company can easily pay off its short-term debts with readily available cash, physical cash, not inventory or receivables. Okay, so let's look at Ankabir again and calculate this ratio very, very quickly. Okay, so in the current asset session, now we are narrowing it and streamlining it to only cash and cash equivalent. So don't forget we have 1st of January and 31st. So we'll take 1st of January, we're taking the end of the year. So I pick cash and cash equivalent. We have 126 million for the end of the year 2020. So I pick 126 million for the cash and cash equivalents only. Okay, so let me move to the next sheet. I post cash and cash equivalent here. Good. Okay, so I can just pick my total current liabilities here. I don't need to go back to the question. I post it here because of time. So my cash ratio is simply Cash and cash equivalent divided by total current liabilities. And we have it as 0.30, not even half, not even up to half. So 0.30, which is to 1. That's like 1/3 of our current liabilities, which is very low. Okay, CAs, what do we have 2020 and 2021? Quickly.
Question, sir.
Yeah.
Hello, sir.
Yes, please.
You said we're going to use only cash and cash equivalent as stated. Is that all?
Exactly. Yes, yes.
Nothing more than that. We're not going to add anything.
No, we're not adding anything. Just cash and cash equivalent, like it's stated on the formula. So we have it cash and cash equivalent.
Okay, sir.
Yep. Okay, so let's quickly calculate so that we can
0.30.
0.3 for 2021.
0.30, one person, another person. Who was that? Rufi, is that Rufi?
Yes.
Aisha. Okay.
What is
Rufi.
0? What
Okay,
2021? 0.3.
Okay, 0.3. All right. 0.30. Julie also 0.30. Julie, are you okay with you also have the same 0.3, right?
Yes, sir. For both years.
For both years. Okay. Who else has Salmat, Aisha, do you have
for both years.
Okay, the same 0.3,
Yes,
0.3. Okay, fantastic. Yes. Okay, fantastic. Let's quickly.
Excuse, sir. In case they don't give us, they don't clearly state it, because this is a giveaway, because I don't think any examiner will give us cash and cash equivalent like that. What exactly are we supposed to pick in case they don't give us cash and cash equivalent just like you did?
Okay, good. So let's go to our ratio. Let's go to our components now. Now we are excluding inventory, trade receivables. So cash and cash equivalent is given. So where you're not giving cash and cash equivalent, or they just say cash. If you see bank, please pick it. Cash at hand and cash at bank. Those are the two you could use for cash ratio. Take note of that. Cash at hand and cash at bank. So marketable securities don't qualify because they are not readily physical cash. They are securities you bought, but you take time to. So from marketable securities down to foreign currency deposits, you can't use them because they are not readily available cash. But anything cash at hand, cash at bank, you can easily withdraw the cash at bank at will. And cash at hand is your petty cash physically. Yes. So where you don't have cash and cash equivalent, please cash at hand and cash at bank will do.
Okay. Sorry, sir.
All right. No, that's fine. That's fine. Please feel free to interject and ask, because those are the exam conditions you could see. Nice question, Julie. Nice question.
Thank you, sir.
Okay. All right. You're welcome. So let me validate that. Let me just go pick the cash and cash equivalent for these 2 years. And I'll just come and validate what we calculated. So I have it here. And I'll just go pick my total liabilities for those 2 years, and I post it here. So let me just drag and see exactly. You guys are correct. Good. So we have it 1/3. If you want to use mathematical terms to explain Dan Kabir's cash situation, is 1/3. Okay, so what's the implication? A cash ratio greater than 1 implies that the company has sufficient physical cash over its current liabilities, and it shows excellent liquidity. So in Dan Kabir's case, no, they don't have sufficient cash. They only have 1/3 of their cash to meet their current liabilities for the 3 years. So it's good they are not holding cash, but it's also risky. Let's look at it. A ratio below 1 suggests potential liquidity concerns, especially where you need cash to settle obligations. So currently, a lot of short-term obligations are done maybe via transfer, via checks, but where you need available readily cash to settle some of them. If you go below 1, you may not be able to meet those obligations. As the company may not have enough cash on hand to meet its immediate obligations. So they may have cash at bank to also settle that, just do quick transfers. But where you need cash to really meet exigencies, it may not be readily available because of the ratio we just computed. So what is the cause and effect? When you have a high cash ratio from 1 above, it shows substantial cash reserves, conservative financial management, or low levels of current liability. So these are the causes of a high cash ratio. Conservative financial management, ensuring cash is available, and low current liabilities, that the cash is above. What are the effects? It increases investor confidence, better ability to manage unexpected expenses. You can just pay off with cash, and favorable borrowing conditions, maybe overdrafts and some other POS guys you need money to collect quickly. While low cash ratios shows high current liabilities, low cash reserves, inefficient cash flow management to some extent, because if you look at currently in practice, you may not want to tie down too much cash, so you do more of transfers. Most chartered accountants that handle petty cash or accountants do transfer with their phone. Currently, that's what is in practice in my office. You hardly tie down cash. It's even riskier and less financial risk in holding too much cash. So effects of in low cash ratio is increased risk of financial distress. So just make sure you have enough cash to meet your obligations, and the challenges will be mitigated. And possible negative impact on your creditworthiness, especially where you need to borrow overdrafts, will have been reduced significantly, where chartered accountants manage these issues very strategically. So in conclusion, the cash ratio serves as a critical indicator of a company's liquidity and financial stability, reflecting its ability to pay off short-term expenses with liquid physical cash resources. So chartered accountants, we are obliged to evaluate this ratio, help stakeholders assess companies' cash management effectiveness and its readiness to address immediate financial challenges. So in our in practice, currently we have a petty cash threshold of about 50,000 currently. Some have maybe 500,000, sorry, not 50,000, 500,000. From 200,000, we looked at the needs and the daily influx of obligations. So we had to go to the board for approval to move it to 500,000. So depending on your situation as chartered accountants, we need to evaluate our day-to-day obligations and make sure we get approval to have a threshold, to have a cash balance in the safe to be able to meet day-to-day activities. So in practice, this is practical. I just explained what happens or transpires in my office and the float that we use to meet our petty cash obligations. This is very important. Okay, so before we move to absolute liquid ratio, it's 9 o'clock. Can we go on 5 minutes or 10 minutes break so that we can come back and conclude on liquidity ratios? Any questions so far?
So please, I have a question.
Okay, please. Is it Salman speaking? I can see Salman's hand up, or is Aisha?
It's Salma.
Okay, yes, Salma, please go ahead.
Yes, sir. Okay, so now we got 30. That's we got 3 points something.
30%, exactly.
30%. Okay. So now
Yes.
Okay, so it's 0.3 ratio 1.
Yes, 0.3 ratio 1, exactly.
So,
exactly.
Okay, so if we got like 1 point something, it would have been 1 point. So I just wanted to know how the ratio something works.
Okay, exactly. So you see, 0.30 means cash is 30% of the 100% current liabilities. That's a graphical way. So current liabilities is 1, but cash is 0.3, which is less than 1. Shows that 30% of your cash is the 100% of your current liabilities. I just used that graphically to explain it. And I believe you caught that explanation.
Yeah.
Yes. All right. So if you look at
Okay,
quick ratio now. Yeah,
Yes.
so quick ratio, you can see 174% of 1. Current liabilities is 1, but quick ratio is 174%. Now, if you go back to current ratio, is 264%, and we have 100%. So if you use that analogy that, okay, our current liability is 100%, then our cash ratio is 30%. You can easily understand it. But in ratio terms, you use how many times, not percentage.
Yes.
Yeah, so if you use how many times, you say 0.30 or 0.3:1. So on a scale of 1 to 10, cash ratio is 3 and current liability is 10. You can just use that to understand the numbers.
Okay, sir. So now this with this results now means that the cash out of Dan Kabir is not good because its cash is lower than it's less than 1.
Exactly. It's less than its obligations. So the obligations in terms of the measurement we use is higher than the
Okay,
cash. Exactly.
yes.
Exactly. That's what
Okay,
it
sir.
means. Yes, that's what it means.
Okay, meaning it cannot this cash it has, it cannot turn it over to solve the liability if like anything happens.
Exactly. Exactly.
Okay, thank you, sir.
You're welcome. All right. Any other question, please? Okay, so let's go on a short break.